In the context of investing in exchange-traded funds, you may often hear of an underlying benchmark described as market cap weighted. With the advent of many new strategies that rely on various factors and other methods of enhanced indexing, market cap weighted indexes are now seen as the more traditional method of passive investing. A cap-weighted index means that each of its underlying stocks makes up a fraction of that index that's in proportion to the size of the stock as measured by market capitalization. For a refresher on what market capitalization means, click on the link below the video player to watch an explainer video as part of our Morningstar Dictionary series. Let's look at a simple example. Let's say an index contains 4 stocks. Company A has a market capitalization of $15 million, Company B has $11 million, Company C $8 million, and Company D has a market cap of $1 million. To determine each stock's weight in the index, we divide its market cap by the total capitalization of the market that this index follows, which in our case is $35 million. In our example, Company A makes up almost 43% of the market, so that's going to be its weight in the index. One of the main reasons why this type of indexing is associated with ultra-low costs is that it doesn't require any rebalancing, since no manager has determined target weights for its holdings. The weights of the constituents move with the ebbs and flows of the market. For instance, let's say Company A goes through a rough patch and sees its stock price go down. Its market cap would be down to $12 million. To keep things simple, let's suppose the other 3 stocks don't see any price movement. The total value of the market is now $32 million, and Company A's share of that market is now down to 37.5%, while the other 3 stocks now make up more of the index. When you decide to invest in an ETF that replicates a market cap weighted index, you're essentially relying on the collective opinions of all other investors to determine the composition of your portfolio, rather than a set of rules determined by a fund company or the judgment of a portfolio manager. There are pros and cons to all of these approaches, and it's good to do your research before making a decision.